Guys, today we are going to practice the exercise number one, the flexible budget, the static budget, and variance report. This exercise is a remarkable example to understand the static budget and the flexible budget, and what is the difference between two. What is the purpose of creating flexible budget and the static budget? And then finally, the variance report creations to see the big picture of all types of variances. You may remember in the class we used that chart, right? The difference between actual result and the static budget is the static budget variance, and in the middle, the flexible budget that shares the same level of output level achieved with actual result. That is the flexible budget variance, and the activity level of variance is between the difference between the flexible and static budget. The static budget is the budget when the company originally planned. That is one output level on the one output level, right? That's why the usually static budget revenue and variables has the huge difference between the actual, from the actual. So let's read the question first. The worker transportation company's general manager reports the quarterly to the company president on the firm's operating performance. The company uses the budget based on the detailed expectations for coming quarter. The general manager has just received the condensed quarterly report shown below. Okay, as you can see, the revenue in the static when they originally planned $13 million, but the actual uh, came up with 12.700. So variance is the unfavorable. Okay, that is fine, totally fine. But the problem is the variable cost comparisons, variable cost variances, this favorable, 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 there are a lot of favorable. This is too obvious because they planned too higher revenue along with this revenue with the higher the output level from the actual, the variable cost as well as the increased because they already the plan that is static budget higher than actual. This favorable result are too obvious, right? So total the variable and fixed cost $116,000 favorable is too, is too obvious, right? That's why although the general manager was upset about not obtaining enough revenue, she was happy. She was happy that her cost performance was favorable. But it's not the right the measurement process of variance. We want to compare at the same level of output with the static budget and actuals. By doing so, we want to know what is the accurate the variance in terms of variable cost and fixed cost. That's why we need the flexible budget, the variance report. Flexible budget is one of the static budget, but flexible budget has a variety of output levels. One of the output levels can be the same as actuals. By doing so, the budget and actual amount in terms of variable cost and the fixed cost can be calculated correctly. Okay, so the revenue variance in the flexible budget is definitely zero. There's no the favorable unfavorable because we assume that on the actual level or the flexible the budget, the output level are the same. Okay, so let's create a flexible budget amount by reading the requirement together. The prepare a columnar flexible budget for worker transportation at the actual level of $12.700 million revenue. Assume that the price and the mix of products sold are equal to the budgeted price and mix. and write out the flexible budget formula for the cost as a percentage of revenue. Percentage of revenue. Why do we need this, the flexible budget formula? We don't have any cost per unit information in the variable cost. We don't have any information. Instead, we use certain percentage of revenue using the static budget information. When they plan this static budget, the pure amount is certain percentage of this revenue. The repairs and the maintenance is the certain percentage of this revenue. We will use this certain percentage as a percentage of revenue in the flexible budget formula. Okay? And then once we created this flexible budget, we'll compare actual, and then you will come up with the variance correctly. Good? Then let's start creating this flexible budget formula. What is this percentage? Right, this divided by the revenue. Here divided by revenue, we come up with 4%. In order to go fast, I want to fix this percentage, and then I will drag down. And then we come up with the flexible budget formula correctly. What is the revenue amount? Again, we assume that the flexible budget has the same level of output as the actual level, right? So this amount and actual are the same, right? We started from this. And then once we started from this revenue, $12,700,000, we apply this 4% to this revenue to come up with the variable cost of here, right? So 4% and this. I also want to fix this, the revenue part, and then drag down. So we have a total variable cost at the same level of output as the actuals, $12,700,000 revenue. Okay. Then what about the fixed cost? Fixed cost actually doesn't have any the formula, any formula. Why? Regardless of what the company achieved some level of output, this fixed cost doesn't change, right? Doesn't change. So we use this information right away. So if there is some certain range where they don't change this fixed, usually they don't change the if there's no big difference in the output level, right? So we use the same amount. So the flexible budget is the same as the static budget amount. Then actual is, we just convert that information into this. So there's no difference. So we can just drag up to this. Then let's calculate total variable and fixed cost by sum up these two fixed and variable costs. Okay. Then I want to use this function just right away. Then how do you come up with the operating income? Right, the revenue minus total variable and fixed costs. Okay. Then let's create the variance report. There's no difference, right? So there's no favorable or unfavorable, nothing. Then the variable cost variance, we can use ABS function, absolute value, the absolute value, the difference between the flexible budget and actual, right? So regardless of what numbers you put first, it will create only positive number. Why? Because the variance is the distance. Distance doesn't have any negative value, right? And then also the same level of output like that. Okay. So let's create now the favorable, unfavorable opinion on it. So in terms of variable cost, if the actual is greater than the budgets, then this is unfavorable, right? and the actual is greater than the repairs and maintenance cost, so this cost also unfavorable. Sorry, unfavorable, 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 also unfavorable. Everything is unfavorable because the actual costs are the bigger than the variable costs. Then let's just take a look at the static budget variance. The most of them are favorable, right? But here, now we realized at the same level of output, the flexible budget and the actual budget, the variance performance is unfavorable. Unfavorable. So she cannot say, oh, happy. No. This unhappy on the cost performance. And then the fixed cost variance unfavorable because it's higher than flexible, and only this is favorable. Oh, sorry, only this is favorable. Then unfavorable. So total variable and fixed cost also the actual is greater than the flexible. And then operating income unfavorable. This totally opposite result from this, right? Is no longer favorable. Okay, so she should report the flexible budget variance report to the president to let him know what is the cost performance effect correctly, right? At the same level of output as the actuals. Then before reporting to this result to the president, we want to see all types of variance in a big picture, on the variance report. Now let's convert all the information into this result. The revenue actual amount is 12,700, and the variable cost. Then the contribution margin is the revenue minus the variable cost, and the fixed cost and the actual. And then total variable and fixed cost we already calculated. So like this. And then flexible budget, we just transform this information into the big picture of this variance report. So variable costs, and then contribution margin, I just want to use functions. And then the fixed cost, how much is fixed cost? Here we go. And then the total variable and fixed cost we already calculated. And then the operating income, right? Also, we already calculated like this. What about static budget? Static budget we have been given. Here we go. Static budget, the revenue, 13 million, and the variable costs, 11. And the contribution margin, the difference between two, and then the fixed cost is 990, and the total variable and the fixed costs. Total variable and fixed costs is the sum up of this, and then the operating income. Okay, I just want to use the information here. Then we transform all the information into the various variance report, and then let's calculate the difference, only the differences. So ABS, the number between two, right? And then let's drag down. Okay, so there's no favorable, unfavorable in the revenue side, and then the variable cost, definitely unfavorable. This is unfavorable because all the actual results are the bigger. All the actual result on the cost, the bigger than the flexible budget, and the contribution margin and the operating income is lower than the flexible budget, right? Flexible budget. So all this, the results on the budgets are unfavorable, right? What about the sales activity variance? the variance between the flexible budget and static budget. Okay, the same with ABS. Then that is the variances. And in terms of revenue, which one is bigger? The static budget is bigger, right? Static budget bigger, but the actual level of the flexible budget share this actual level. So, right, this is unfavorable, right? Because the actual level is lower than the static budget. And the flexible budget shares this actual level with the actual result, right? And then the variable cost, this is favorable. This is favorable. Oh, sorry, this is favorable. Because in terms of variable cost, the static budget, they planned 11, but it's 10 million, right? Then the contribution, which one is bigger? Right, the static is bigger, but the actual is lower. So unfavorable. Then this is favorable, and next is unfavorable. What about static budget variances? We already got that information here, but I wanted to use this understanding, this process. Just we can sum up the flexible budget and variance, flexible budget variance and the sales activity variances. Why? Because let's come back to the variance summary. Because the static budget variance is equal to the flexible budget variance plus activity level variance. So I want to use this sense of understanding. So we don't have any flexible variances. So this 300,000 is the static budget variance. So unfavorable. How about this? The favorable sales activity favorable is greater than the flexible budget variances by 126,000. And then this sales activity variance is greater than the flexible budget variances. The sales activity variances is the favorable. So that is a favorable. What about the contribution margin? Contribution margin, they have all unfavorable information, right? Then the fixed cost, only we have 10,000, the unfavorable and the flexible budget variances. So this also unfavorable. What about the total variable and the fixed cost, the variances in the static budget? Can just sum up? No, because the sales of the activity variances is favorable. So which one is bigger? Okay, that one is bigger. Minus this. So $116,000 is favorable. And then finally, we have two unfavorable. Then you can just sum up with two unfavorable, so unfavorable in total on the operating income. Then let's compare this information, the static budget variances with this 300,000 unfavorable, then 126,000 favorable. Here you go, the total variable cost. And then the 10,000 fixed cost, 10,000 fixed cost unfavorable. And then the total variable and the fixed cost 116,000 favorable, right? And then 184,000 unfavorable in terms of operating income. Okay, then it's correct. All the processes are correct. So, to present this variance report to the president, okay, let's create this chart and table beautifully. Okay, then that's the result. Once again, the flexible variances shows all the cost and the margins and the operating income shows unfavorable, and then the sales activity variances create some the favorable because the static budget is starting from very high level of output achieved, right? When they achieve a high level of output, variable cost also increase. That's why the static budget variances and the variable cost create the huge amount of favorable amount, but it's not the correct information to report. That is the right result to clearly understand the cost performance report. Okay, okay, you guys, today, good job with amazing exercise, and see you the next video clip.